Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Tuesday, December 19th, 2023, and this is Blockhead Traders Weekly. In this week's episode, which will air on Christmas Day, we are pre-recording it. It is just myself, Sprocket 888, and I am here to talk to you a little bit about my primary strategy, Delta up, Theta down. And we'll get into what exactly this means in this episode. These are option Greeks, and it is tied to a premium selling play, and it is a strategy that I like to lean on quite heavily. But first, I'd like to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what strategy you like to deploy and love to hear what type of content you want to hear about. You also find a link to thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. Last, you can get this in an audio-only format wherever you get your podcasts. Let us know, subscribe there, and if you can't find it, let us know and we will get it there. Let's hop to this week's content of Delta up, Theta down. What does that mean? This is a strategy that originally got me into trading a long time ago, back in 2019, and it basically is a concept built on premium selling. So Theta is the amount of time premium that is baked into an option. So think of it like the period of time for a coupon to go expired. So if you have to pay $10 for a coupon and it expires in 10 days, that coupon would lose $1 a day if it was a linear decline. So if you paid $10 and after it expires, it's absolutely worthless. If it declines linearly, you lose $1 of value in that day. So if I sell you that coupon today for $10 and you wait 5 days and don't use it and you want to sell it to somebody else, that coupon would have around $5 in value. So if I sold it to you for $10, but then I wanted to close it out, I could basically buy it back for $5. I now have the coupon plus $5 difference between what I originally sold it to you and what you had to sell it back to me after that value declined. And that is basically what Theta is. And so in my premium selling strategy, I sell options that have extra high volatility on a time horizon where that Theta decline seems to increase more rapidly. Not seems to, it does increase more rapidly. So in options time decay, it increases the faster you are to expiration, kind of like a roller coaster picking up speed as it's going downhill. And so every day that decline gets faster and faster once you get inside the 35 to 45 day window. This is typically where I like to start selling those coupons, anticipating that the underlying price will not move far enough to make that coupon valid. Delta, on the other hand, is directional risk. So if you have a very high positive delta, you are very biased to only making money if you move in the positive direction. So if you have a delta of, say, 100, for every dollar you move, you would make $100. That means your portfolio is heavily weighted with positive delta. If you have negative delta, kind of the flip side is there. So negative 100 delta says for every dollar that you go down, you basically will gain $100. So that means a move in the negative delta direction is biased to you. And so a delta value of 0 would mean that effectively it doesn't matter if the market goes up or the market goes down, your value stays the same. So the higher the delta value, the more amplitude you have when the market swings in the up direction, and the more negative the delta, the higher your gains are if it swings in the negative direction. That's a double-edged sword, so the reverse is also true. If you have a very positively weighted delta and the market moves against you in the negative direction, you will lose money very rapidly. And if you have a delta 0 position, then you're very much not affected of the market movement. So market goes up, market goes down, your portfolio really stays the same. You might think, well, why on earth would anybody want that situation? You would want to bias your portfolio either to the positive direction or to the negative direction based on your market sentiment. Well, not when dealing with time decay, which is why the strategy is theta up, delta down. So with time decay, the more time that passes, the more value comes off of that option. And you sell all that time premium up front. So in order to close it back, you're basically buying back the remaining value to close out the position. And so you don't really want a lot of delta exposure, because in the premium world, you want you to basically idle there and kind of decline in premium. And so with no delta directional risk, it doesn't really matter if the market goes up or the market goes down. All you need to do is see time pass. And that's really the thinking behind this theta up and delta down strategy. And I just want to take this as a special Christmas episode. It's coming up on the end of the year where we typically do reflections back. And I just wanted to kind of reiterate, in my world of experiments, where do I stand with that, and how has it fared for me over the years? Now, the first place I want to start is my portfolio manager, because in my plan of theta up, delta down, I really only participate, engage in kind of two factors. That is, what is my portfolio theta decay, and what is my portfolio delta? Now, a delta varies, based on what type of stock you have, kind of like apples and oranges. They're all different. They all can move differently. Well, there's a thing called beta weighting, which basically says, hey, let's take a common denominator, and we will calculate all of that price movement relative to that common denominator. And so for me, I use the SPY. That's the index of the S&P. And in my brokerage platform here, Thinkorswim, you basically can state what you want your beta weighting ticker to be. So I could beta weight against anything. I choose the S&P because it's a pretty cross-functional index and gives me a nice demographic across the board of all the different type of holdings that I might sell premium against. And so I put that value up here, and then I check mark this beta weighting. And the reason I do that is because if I don't check that box, let's look over here on this column where there's a delta. So these are the deltas. Now, these are deltas that are not beta weighted. They're not normalized to that common ticker. And they're kind of all over the place, and they don't really mean much to me. So when I apply this beta weighting and we look at this column, all of these delta numbers now change. So this is the amount of delta relative to the S&P. So what does that mean, for example? And so right here, this ticker WBA is Walgreens Boots Alliance. So this stock basically has a delta of negative 3.27. Not the stock, but the option position I have open. So it's very delta neutral. So it says, if the S&P goes up by $1, I will lose $3.27. If it goes down by $1, I will gain $3.27. So I am negatively biased here with this WBA position. And you can see some of these other ones have varying degrees of delta. And what I really want to know is, what's my overall portfolio delta? So what is the delta risk that I have? And I'll show you another worksheet, but basically I like, because 0 is 0, but you're never actually at 0. So given my portfolio size, given some range, I have a calculation that I use, and that helps me gauge, what is considered delta neutral. So it might be plus or minus $5, might be plus or minus $30. So my delta neutral is if my deltas are plus or minus about $55. So if I have a positive 55 delta all the way down to a negative 55 delta, I treat that as delta neutral, delta 0. And I'll show you where I have a sheet that kind of calculates that. Now, if I get above that, that's when I start saying, okay, now I have a bias. So if I was, say 100 delta, I would be biased by my 0, what I consider 0 as negative 55 to 55, by about 45 delta positive. So I try to keep that number in that delta 0 range at all times. And, I'll take action once I get kind of 2x outside of that, 2 to 3x outside of my targeted delta. So I'm not really going to try to do something on my portfolio to manage that until I'm, plus 150 or minus 150 delta. And so if I look right here, what my portfolio currently has, unfortunately, it doesn't add all this up, but you can kind of do the math in your head. I got negative 185 delta up here. That's very, very heavy negative delta. But I have a lot of stock positions down here, which kind of counteract that. And so I got about a 54 delta here, and then this little tiny, 1.5 delta in here. And so I'm largely looking at 55, 50, so about negative 130 delta if I add these up. That is approaching where I might consider trying to maintain or manage this, where I'm getting too far of directional bias. But for right now, it's a little bit biased to the negative side, which means I'm a little more tilted to the market going down. I make more money if the market goes down with my negative delta bias at the moment. Now, theta, where does theta come in? So theta is the decay of option premium. And so this unallocated section here, these are all shares that I hold long of some kind. And you'll notice all of their thetas are 0 because they have no time premium. They're just shares of stock. There's nothing to decay. And where we start picking up theta is up here with these other positions, which have expiration. And so these are options expiration. You can see this natural gas option here has a 44 theta, which means every day that goes by, that option declines $44 in theta, effectively putting $44 in my profit every day. This one only has 18 cents of theta. It's pretty much worthless at this point. Then up here, I've got two positions that add up to about $116 in theta. So every day, if I add this up, I'm looking at about $161 in daily theta. And so this is what I mean by theta up, delta down. I want to keep that theta high, and I want to keep that delta as neutral as possible to cash in on those trades. So let's take a look at a worksheet that I use. Now, I'm going to put a link to a previous episode in here. It's a long, long time ago. I actually published this sheet as part of one of the episodes as we walk through it. And I think it would be good to revisit this. I got to put a little bit of tweaking on this, some changes I want to make in my tracking. But this is effectively the worksheet that I use to do all of my trade journaling. And this sheet here that I've got pulled up is effectively my barometer, my navigation screen, if you would. And kind of ignore the different front months delta adjustments. Don't worry about that. What I really care about here is my net lick. So what is the net liquidity of my account? So if my account was a $26,000 net liquidity, I set a couple of parameters. I said, hey, how much of my buying power do I want to utilize? It will then tell me how much buying power I should have free on the ready at all times in my balance. I basically then set what is my trade size that I should be targeting. And then based on this trade size, how much of my portfolio I'm risking on each trade, it will then tell me, how big of a risk I should take. When I look at undefined risk, what percentage of my portfolio am I taking on undefined risks? If I do, where value does that have? But right down here are my delta target and my theta target. And so given this calculation, I typically like to target what's here is 0.2% of B2, which is my net lick. So 0.2% of my net lick should be what I try to have as my plus minus delta. So the bigger this portfolio gets, so let's say this thing, went up to $86,000. You can see my delta neutral target is now plus or minus, $172. If, my portfolio got smaller and I was dealing with something like a $15,000 portfolio, okay, you can see my delta target is plus or minus 3 or 30. So if I keep this at 26,000, the other thing that I have here is what is my daily theta target? And what I like to try to target here for my daily theta, you can see in the formula up here is 0.4% of the net liquidity times how much of that net liquidity am I actually putting to work. So I need to take out, 25% of that and then say, okay, based on $26,000, I want to try to keep a daily theta of at least $78. And so this is where I take those two values that I just showed you in the previous screen and say, okay, where am I? So am I within my plus or minus, $52 here? No, I'm not. Okay, that means I'm starting to have a delta bias. So do I want to take a corrective action? That's where I get into, okay, hold steady until you're about 2 to 3x where you want to be. Then it's time to consider some adjustments. So I'm not quite to the 3x. I'm approaching it, but at 130 delta, that's not quite 3x of 52. So that's why I'm saying, okay, I'm still kind of delta neutral, but I'm not delta neutral, but I'm not quite to the point where I want to take some adjustment. So where does theta stand? And if we look back there, that was dealing in one column about 117 and then 44. So about $160 in theta. Well, that's fantastic. So I'm targeting, $78 in theta, but right now my portfolio is at, $160 plus in theta. So I'm really sitting pretty good from a portfolio navigation screen. And this is really means no management necessary right now. I don't need to go look for more theta, and I don't need to take adjustments on my particular delta. Now, if I needed to do something, I would try to pick up, and kill two birds with one stone. So let's say my theta was low and I needed to go pick up theta, but my delta was, high bias to the negative side. I'm going to try to pick up theta that has a positive delta bias. So I can bring up my theta and then counter the negative delta that the portfolio might have with some positive delta to help bring that delta back down to a 0 level. And this is the whole crux of how my trading mechanics really work around this. And, you might think, oh, that's great, but where is the proof? How did you do? Right here, this strategy, my estimates are, hey, given all of this stuff, I speculate that I will be able to keep about a quarter of the premium that I collect. Now, that's pretty conservative, but this basically says that given 26,000, if I maintain this delta and theta numbers, I should expect to receive about $600 in premium a month. Now, that's a little over 2% return. I think 2.3% of $600 return on $2,600 cash buying power. Now, it's actually a little bit more than that of a return because I'm only utilizing 75% if I'm fully deployed. And right here, this active defined and active undefined basically tells me how much, given my current deployment, do I have to deploy. So this is where it takes into account some of, what my currently is out there. And I basically have about $9,000 presently of more buying power that I could consume. But I'm going to keep that on the sideline because right now I'm hitting my numbers. I'm hitting my daily theta target at 160 some, and I'm not blown out my delta target. So I'm going to keep this powder on the sideline to make adjustments and things like that. Another thing I want to show you here is just my own tracking of how this has panned out for me. Now, if going back in all the episodes, if you're a longtime listener, you'll probably know that within the year of 2022, I really kind of drifted away from this strategy, kind of experimenting with a lot of other things, and it didn't go so well for me. And I keep this all in a trade journal, and I kind of throw it up all on a pivot table. So I'll kind of scroll up here a little bit to make sure all of it can kind of fit in the window a little bit. And what you effectively have here is every single month and the return that I had on the investments that I put in there. Now, you don't really have my, the core holdings on how big is the portfolio, but what I really want to kind of call out here is just notice here in 21, I did really well. So these are kind of the monthly return numbers. You can see they're all consistently kind of in the 4-digit range. Now in 22, this is where the market got off to a pretty hop and start here in January. Then things started going south, and this is where I tried to get cute with a lot of my trading strategy. And you can just see this just really not that great a performance there throughout 22. A lot of the months were negative. We had negative months, but a lot were only even in 3 digits return when I was making returns. Now, if you remember, that's not that far off from kind of my estimations, but it really was drifting from my strategy. I was getting assigned different things. It didn't go very well. And you'll know that, in around the middle of 23, I switched back to this strategy of let's just go back to the bread and butter. Let's go back to what works. I had a proven track record within 21 on how that all panned out. So in, halfway through 23, I started switching back, and it's a stark difference here where you can see, yeah, there was a switch that flipped. And yeah, there is a bad month in here, a weak month in here, but you're never going to hit those home runs every time. And my forecasted numbers of what I should be keeping from my premium were really beating that estimated $600 a month. And like I said, that's a conservative number. When the market starts swinging, depending on where the bias is and things like that. This is just kind of a proof in the pudding. This is the tracking that I did that really kind of shows, yeah, this strategy does work. Now, it's one thing to call out some random spreadsheet that you keep hidden away, that you guys can't take a look at and can't know that. Well, that's where the whole thetagang.com/sprocket 888 is. This rolls up every one of my trades. I come in here and I input them. I've been doing it since 2020. There might even be a couple in here in 2019 when I first found this site, but it tracks all of my trades. It does a very nice job of kind of rolling them up and kind of puts into perspective, where's the Pareto of what were your big hitters, your big losers. And so looking at 2023, you can see I had a win percentage of 71.25%, 57 winning trades, 19 losing trades, 4 assignments. I held these things for about 18.7 days. Wheat was the big winner, cumulatively at over $3,000. Carvana, I pulled in, 1,600. You can see, look, most of these greens are just, small, couple $100 here, couple $100 there. And you get down into my losers and look, not a whole lot of losers that I picked up as far as, where they fit in the Pareto of biggest losers, biggest, what tickers do you have? How many times did you play them? You can see I played C3AI 6 times. I played Carvana 6 times. Wheat, I played 6 times. What type of strategies did I do? Puts, calls, condors, where did everything really fall? And I can, flip that. They got the 2023 rolled up here. You can click over here to 2022 and you can get my 2022 numbers and you can see, wow, you did a lot less trades. Your win percentage was not even 50%. The net premium collected that year, not so good. My trade was longer, trade length was longer, wins, losses. And then I can take a look here at 21. I can go back to 21 and say, okay, look, the win percentage was 66.5. Okay, so I'm doing better now with my win percentage in the 70s. And that's where I think I'm starting to dial in the, in 2021, a lot of my trades were, let's just do as many as I possibly can and just throw as many names out there, right? Look at how many of these names I threw out here. Look at how many of these tiny little things I threw out there for the trades. And there's more losers in here. But this was where I was still not really going for that uber stretched volatility or certain nuances that I started picking up, in 23 when I went back to the bread and butter. If I go back to 2020, okay, so none of the trades show up here. They must have done something because I definitely used to have trades tracked here in 2020. But anyway, 2021, you can see 66.5%. 2022, I barely had a 50% win rate. It was just not a good year. 2023, going back to that bread and butter. I mean, it's all numbers here, guys. So that's really the end of the episode here for this week. Not a lot of content to show other than kind of a reflection back on the year. I'm very happy that I'm returning back to my bread and butter strategy. It really served me well within 21. I drifted away from it within 22. I learned a lot of things that didn't work. And then it was more, okay, the market environment is different. What happens if I come back to it in 23? And just like I was hitting out in 21, going back to that strategy, returned similar results of that yield. And so I'm happy to be back in this strategy. I'm monitoring my portfolio. One of the big differences that I've done is I've put significant cash holdings now in U.S. Treasuries. Rather than just letting the extra cash sit idle in my bank account. So remember on that, portfolio utilization, I'm only utilizing at most 75% of my portfolio, but most of the time it's even less utilization than that. So a good chunk of that cash is still just sloshing around in my portfolio, not really picking up much of anything. I deploy all that against U.S. Treasuries to just grab some of whatever that 4-week Treasury bill return is. That is a whole lot greater than zero, but it's certainly nothing to add a ton to the bottom line. I think I do it in 2-week tranches. I do about 5 of those out there. Each one yields about $8 per period. So I'm pulling in about an extra $40 a month simply from US Treasuries in that deployment. So it just puts that cash that's going to be on the sidelines to work instead of just sitting there and doing nothing. And I really just want to kind of encourage you to find your groove in 24 about the strategy that works for you. Start making it mechanical, start tracking it, start proving out the thing, and do it for a long period of time, because that's really what makes your results statistically significant. If you try it for a trade, then switch a strategy, then try it for a trade, then switch a strategy, you're not really going to accumulate enough data to make a good judgment on whether or not that is or is not working for you. So good luck out there. If you happen to be trading in the last few days of the year, the volumes will be light, so not a lot of action happening out there in the market, but best of luck to you. And remember, as always, think outside the block.